Hello everyone, my name is Hitesh and I welcome you all to this small course on futures and forward market. I'll be a moderator for this course and will be dealing with various concepts regarding the forward market and the future markets and its various mechanisms in detail. So sit back and enjoy a ride on this. So before understanding the concept of futures market, we have to understand what exactly a forwards market, because a clear understanding of the concept of forward market will go a long way in understanding the concept of futures market in detail. So before moving on, a small fun fact: the National Stock Exchange commenced trading derivatives in India on June 12, 2000 with the launch of index futures. So before the launch of stock futures, the index futures were the first product which were traded under the variety of derivative trading in India. Now the exchange introduced trading in index options also based on Nifty 50 on June 4, 2001. And futures on individual securities like shares of the company were introduced in November 9, 2001. So looking at a brief outline, June 2000 was the time when the trading of derivative was started. And after that, we got on to trading of individual securities and other instruments in the options and futures categories. And recently on Jan 11, 2021, NSE added Nifty Financial Services as another instrument which could be traded under derivative segment. So previously there were only two major indexes trading in the derivative market, that was the Nifty and the Bank Nifty. Now we have Nifty Financial Services, which is also being allowed to trade under the derivative segment. It is yet to catch momentum, but with time and the amount of securities which are a part of the segment, so I won't be surprised if it eventually becomes one of the major product in the derivative market. So now let's move on and understand what exactly a forwards market. So forward market is an over-the-counter. When I say over-the-counter, it means OTC marketplace that sets the price of financial instrument for future delivery. So now what happens here is this: supposedly if there are two parties, that is A and B, and they want to get into agreement to buy or sell a certain commodity, so they get into the forwards market. They set a pre-decided price, pre-decided quantity, and the pre-decided date for buying or selling of the underlying asset here. So that is the basic premise of forwards market. So the next point is, why exactly was forward market developed? It was actually developed to protect the interest of farmers. So what would happen is, earlier when the agriculture were produced by the farmers, they were not aware as to what the price they should be charging or what would be the price in the future. So to protect their interest, they were given the option to pre-decide their price for a specified amount of quantity and at a specified time in the future. So they would actually get the price which they decide now in the future, and it wouldn't matter what the price of underlying asset or the agriculture produce was that time. So it gave a sense of security to farmers, saying that they were aware that this is the amount of money which they would make on the agriculture produce, and they could plan their things accordingly. Now, under the forwards contract, there is no third party involved. It's an over-the-counter agreement. So what happens in an over-the-counter agreement? The two parties involved set the conditions for the trade. There is no one regulating them. There is no one overlooking the transaction here. It's between those two parties. They decide when to buy and what quantity to buy and what price they decide to buy. There is nothing called a regulatory body here. It's just an agreement between the two parties. That is the basic premise of OTC agreement. And upon expiry, both the parties involved will have to honor the agreement. It is basically mutual respect of the parties towards each other, and they decide to honor the agreement at the time of expiry. That is how a forward market functions. Now let us understand the concept of forward market with the help of a simple example. So say Mr. A enters into an agreement with Mr. B to buy 10 kilograms of silver in 3 months down the line. Now, if you look at it, this looks like a classic case of I'm willing to buy something in future, but I'm not aware of what price I should buy or what will be the price of that commodity in future. So I want to lock in the price right now. So what happens? Both the parties fix a price of say rupees 60,000 per kg, and the date of agreement, that is the date and when the contract starts, is 1st of January 2021. So on the last day of March is when the contract will settle, and on that day Mr. A will have to give the amount of money for 10 kgs of silver which is pre-decided to Mr. B, and Mr. B in return gives 10 kg of silver to Mr. A. And Mr. A is expected to pay Mr. B a sum of rupees 6 lakh on the day of expiry, which is the 31st March 2021. And the important point of consideration here is that the future price of silver on the last day, that is the 30th March 2021, has no bearing on the forward contract pre-decided price. What happens? Supposedly, on say 30th March, if the price of silver goes up or down, it doesn't make a difference to this contract, because the contract price is pre-decided. The contract will be taken, or the contract will be honored at the price which is pre-decided, that is rupees 60,000 per kg for silver. So that is how the forward contracts work. The current price on the future date doesn't hold any bearing on it. It's the price which is pre-decided is the most important factor in the forward market. Now, what are the possible outcomes of a forward agreement? So there could be three cases. The first being if the silver price goes up. Now, what happens in that case? Supposedly, if the price of silver goes up by rupees 10,000 per kg, then Mr. A stands to gain here. And how does that work? So what was the initial agreement? That Mr. A will have to buy 10 kg of silver from Mr. B at rupees 60,000 per kg. Now, upon the expiry on 30th March, say if the price of silver goes up by 10,000 rupees per kg. So what happens on the day of expiry? Suppose if the price of silver goes up by rupees 10,000 per kg. So now the new price of silver is rupees 70,000 per kg. But according to agreement, Mr. A is supposed to buy at 60,000. So his benefit will be 70,000 minus 60,000 into 10 kgs of silver. So which gives him a benefit of rupees 1 lakh. That is how the buyer in this case stands to gain when the price of underlying security goes up. Say if the price of silver comes down. Now what happens in that case is, so A has to buy at 60,000 rupees per kg, but the price of silver has come down to say 51,000 rupees per kg. So what happens in that case? The benefit of the seller of the silver is set to benefit. And how does he benefit? He benefits to a tune of 60,000, that is the agreed upon price minus the current price into the quantity. So the total benefit to Mr. B, that is the seller, is rupees 90,000 in this case. And the third case which is possible here is the price of silver remains unchanged. Basically, the price of silver has neither gone up neither come down. It is still at 60,000 rupees per kg. In that case, both the parties neither gain or lose anything in this transaction. It's a null and void transaction in that case. Now, having understood the basic premise of forwards contract, let us try and understand how a forward contract settled in the market. There are two ways of doing it. Either it's through physical delivery or through cash settlement. So what happens in physical delivery? If we look at our example of silver, now if the mode of settling the contract in this case is physical delivery. So upon the expiry, Mr. A will have to pay rupees 6 lakh to Mr. B, and Mr. B in return will have to give 10 kg of silver to Mr. A. That is a way of settling the physical delivery. Now what happens in cash settlement? In cash settlement, there is no physical delivery of any goods. Only the cash differential will have to be paid. Now I'll explain with the help of example of silver only. Supposedly upon expiry, if the price of silver say went up to say 65,000 per kg, in that case Mr. A stands to gain rupees 5,000 per kg. So in case of cash settlement, the differential of rupees 5,000 into 10 kg will have to be paid by Mr. B to Mr. A. There is no physical delivery of any sort of commodity or any underlying asset. Only the cash differential will have to be paid by the losing party to the winning party. That is the two way of settling the forward contract. Now, having understood the way of settling the forward contracts, let us try and understand what are the various risks associated with forward contract. Now, if it's an international derivative agreement, there has to be a certain level of risk which comes with the agreement. The first of which is liquidity risk. So what happens? There is nothing called as exchange where the product is traded. So a party which is willing to take a counter position to your views can sometimes become difficult in the market. Say if I have bullish view on say shares of certain companies, say Reliance Industries, and I'm expecting that the market price will go up. I want to fix the price right now. But in case of a forward contract, it might be difficult to find a party willing to short or willing to sell the Reliance Industries to you. And because of the simple fact that there is no exchange, so liquidity can become an issue while trading forward contract. The second issue is the default risk. As there is no legal authority governing the contract, there is no exchange or there is no bylaws for these kind of contract, there is a chance of default. It could happen that the one of the party who's losing at the time of settlement of agreement might just back out from the contract and they're saying I'm not willing to pay. Of course, you can go to the legal route, but we all know what are the risks or how much of the time is taken just to finish the legal formalities. So that is one default risk is one factor while trading forward contract. The next is absence of regulatory authority. I've been mentioning this that it's an OTC agreement and it's between two parties. There is no regulatory authority which settles the forward contract. There is no exchange or there is no governing body here. So which could again sometimes lead to dispute between the parties because there is no one regulating the market. And the fourth point is can't bail out between the agreement. Now this is very important because supposedly if I have a certain view on the shares of XYZ company and I have bought the forward contracts thinking that the price will go up in future, and supposedly between the duration of my contract I feel that the market will come down and I want to get out of my agreement. Now in that case it becomes difficult for me because there I will have to first starters find a party is willing to take a counter agreement, and because liquidity is a factor I'll be stuck in my position and actually I'll have to bear the losses even though I knew that the market is bearish and my views are wrong in the market. So liquidity becomes a major factor, and I can't bail out of agreement because it's a start day and end day agreement. You can't bail out of agreement in between in case of forward contract. I hope this basic video gave you a basic understanding of forward market. What are different kinds of forward market? What are the various ways of settling it? What are the various risks associated with it? I hope to see you in the further videos of futures trading. Thank you for your patient hearing. I'll see you in the next videos to come. Thank you so much.